Hi, I'm Wallace. I'm the founder and CEO of Above Board Financial, and in this video, I'm going to talk with you about a specific life insurance calculation for a single mom by choice. And I'm going to screen share here. We're going to look at it together. But before I dive into that, I just wanted to say up front that you don't have to understand or even watch this video to get an appropriate amount of life insurance coverage. This video is going to go full nerd with a ton of numerical detail. And so, if that sounds exciting and interesting to you, awesome. If you are a financial advisor who's wondering about how to think about this for a client, awesome. But if you're like at any point, you know what, this is really more than I wanted to sign up for, that's completely cool. Like, you don't have to do any of this. You can come visit us at aboveboardfinancial.com and we will be happy to do this for you and make sure that your coverage calculation properly reflects the goals that you absolutely can speak to, right? Which is like what you would want to have available for your child or children if, God forbid, you were hit by a bus. Okay, so with that said, I'm going to go ahead and screen share here, and the full nerdery shall begin. All right, so 45-year-old single mom by choice, planning a normal retirement age, makes about 250,000 a year. She had gotten a $250,000 life insurance policy many years ago. Only thing we know about it is that it's a term policy. We're going to assume for now that, and the odds are frankly very good, that she's not going to do better now that she's 10 years older than this existing coverage. And therefore, we're probably going to just add to the existing coverage instead of replace it. Now, in practice, if you have existing coverage, you can just shoot it to us at hello@aboveboardfinancial.com and we'll do a complimentary, like, quick look at it for our clients. Um, what debts do you have? She's got a $1 million mortgage. And this question of would you want the mortgage paid off in full if you died? For most single moms by choice, the answer is going to be no. And that's because the most common approach for single moms by choice is to plan for their child or children to move in with a different household if, God forbid, something happened to them. Now, importantly, there are some SMBCs who choose differently and would want a trusted grown-up or grown-ups to move into their home and basically step into their shoes as best they can and try to keep life as consistent as possible for their children. And totally works too, right? I'll show you how to adjust that calculation if that's what you want. But for now, we're going to assume if something happened to this mom, let's imagine that, her brother and sister-in-law would take the daughter, and her house would get sold. All right, so how much of your household savings exclude any home equity? She has about $1 million saved currently. Do you have any children? Yes, she's got a 1-year-old, and yikes, that is a real number. 95,000 a year is what the elite universities and colleges are pricing out at these days. And let's also assume that she feels like replacing, you know, the lost income that would come from her death is what she needs for 20 years, right? That she kind of feels like, okay, if I were hit by a bus tomorrow, getting my daughter to 21 feels adequate. If I were hit by a bus in 5 years, getting her to 26 is okay. Or importantly, most carriers will let you reduce your term coverage once you're at least a few years into the policy. So if in the future you feel like, I don't really need this much, that is often an adjustment you can make by simply calling the carrier. You can reduce your coverage without going to zero a lot of the time. No spouse or partner and no other financial dependents. So let's check out the coverage. All right, so the initial recommendation is 1.6. Now, if when you're on our website at aboveboardfinancial.com, you're kind of like, all right, I think doing that is enough detail for me now. Just hit this button, keep going, get quotes. And what'll happen is after you complete the brief health questionnaire, which is just between you and us, so we can make a decently informed estimate of the pricing that you would likely qualify for. Once you see those quotes, what happens is that we'll be able to pull up not just your quotes, but also your calculation and run this customization for you, right? So we can help you think through that and make sure that the coverage amount really aligns with what you would want. Now, here in this video, I promised you that we were going to go full nerd. And now we're going to like really ramp up the nerdery and go into a lot of detail. And to do that, you can click on learn more about our assumptions. And let's see, well, where does this 1.6 come from, right? Let's start there. So your financial goals are 2.6 million. And if you look at like, okay, well, what's the biggest driver of that? Well, it's replacing income or replacing 80% of income for 20 years, right? And we'll go into the details in a minute. We're assuming that she wouldn't want to pay down the mortgage, so that's zero. And then we also offer some buffer here where we assume that you want to fund 100% of kids' college. Oftentimes, between replacing 80% of income and funding college in full, that gets you in the ballpark. But you keep in mind our calculator is used by thousands of people. And so for our starting assumptions, right, we want to pick something that gets most people in the ballpark, but we totally recognize that there's not one set of assumptions that's going to be exactly right for everybody. This is why we're happy to help you adjust it to make sure that it reflects your goals. Now, additional money for heirs, totally cool to leave that at zero, and that's how you get the 2.6. Now, for survivor's assets, that's 1 million. And that's coming from assuming that 75% of her 1 million of existing savings would be available. Because at the risk of stating the obvious, if she's hit by a bus before retirement, she no longer needs her own retirement savings, right? That money gets freed up to support her daughter. So why 75% instead of 100? Well, again, on the topic of thousands of people with very different situations using this calculator, we're trying to pick a number that gets most people in the right ballpark. If you know, for example, that 100% of your assets are in like a Roth IRA, you can totally change this to be the full $1 million, right? You can make that adjustment or we can make that adjustment for you. But a lot of people have a good chunk of their savings or what they think of as their liquid assets in something like a 401k, where if their surviving family needed to turn to that 401k money, taxes would be due, right? And then it becomes a question of like, well, what's your federal tax rate? What's your state tax rate? And so we found over time that 75% is a good starting assumption. But again, if you feel like to reflect your situation, this needs to be changed, you can do that, or we're happy to help you do it. Now, current life insurance, like I said, we're going to assume that she's best off just adding to that instead of replacing it. And that's where this number is coming from. But you might notice home equity. And we said earlier that she's thinking about selling the house. Well, this is our first adjustment, right? Because most people who use our calculator don't plan to have to sell the house if they died. Often, usually the goal is that the surviving family would stay in place. But in this case, it's not, right? So we're going to add in the 250,000 of home equity that she has. And you can see the coverage amounts going down. There's some rounding here, but this is sort of just to get us in the ballpark. Now, let's imagine too that she looks at this and she's like, yeah, no, I like the idea of having college fully funded. Like that feels right. I want it to be like very clear that there's more than enough money for college. And hopefully that even is able to help a little bit with maybe some grad school if she decides to go. But with this lost future income number, right, in the scenario where a single mom by choice envisions her kids moving into a different household, she's no longer going to have living expenses herself. And so then the question becomes like, well, what's the right number to support the kids? And in this case, right, you can see that this is, in ballpark numbers, about, a little over $12,000 a month. And she probably will feel like, you know what? My daughter does not need $12,000 a month to go live with my brother. And that's a completely reasonable assessment. However, I think I would also encourage you to like just sort of start with the assumption that whatever estimate you have of your monthly expenses for your kid, it's probably a little bit low, right? Just because I think myself included, but I think a lot of people that we've worked with tend to underestimate their expenses, right? If you ask them what they are, and then you compare that to what they actually find when they go look in their bank statements or, use one of those like apps that'll calculate it for you. Very few people are surprised to find out how cheap their kids really are, right? That's just not usually how it works. So I would take whatever you think it is and then maybe like give yourself a little wiggle room. So let's say in this scenario, she says, you know what? I think that I'd like to replace, 50% of my income. Like that feels like a good number for supporting my daughter in a really robust way. And maybe she's talked to her brother and sister-in-law and they've said like, hey, like we would love to take your daughter if God forbid that happened. However, we both work full time. We're kind of at capacity. Like we would really need to hire like a full-time provider of childcare if our family grew. And so, you might want to factor in some extra expenses like that, build in some wiggle room. But let's say that she looks at this and says, okay, like that number feels right to me, right? So in that case, 500,000 would be a good coverage amount for her. Now, let's switch gears and imagine instead that she's like, no, no, like if something happened to me, my sister would come move in to my place, try to keep life as consistent as possible for my daughter. And, my sister is a wonderful person, but she does not make a ton of money. And I wouldn't want her feeling constrained or stressed out about finances herself. So I would want to replace 100% of my after-tax income just to make sure that she and my daughter were every bit as empowered as I am to create the life experience that they want. And that's the number that feels right to me. And then, oh, by the way, because we're no longer assuming that the house gets sold, we got to change this home equity assumption to 0. And so now we have a coverage recommendation. Let me just make sure that went through correctly. Cool. So now we have a coverage recommendation that reflects a very different vision for what would happen to her daughter if something happened to her. And none of these answers is right or wrong. It's just purely a reflection of matching the calculation to reflect what you want. So come visit us at aboveboardfinancial.com and we'd be happy to help you make sure that your policy stands ready to do what you would want it to do.